A lot of people assume that if they're able to buy a $500,000 house, it means they're in a strong financial position. It feels like a clear sign of progress. After all, if the bank says yes, the numbers must make sense, right? The lender reviews your income, checks your debts, and runs the calculations. If everything fits within their requirements, the loan gets approved. On paper, the payment appears to align with what you earn. The purchase seems reasonable. But there's an important difference most buyers never stop to consider. There's a difference between being allowed to buy a home and living comfortably with that financial commitment for years to come. Mortgage approval simply means the bank believes you can make the payment according to their guidelines, but those guidelines are designed to protect the lender, not necessarily to protect your long-term financial stability. Real affordability is a much bigger question. It's not just about whether you can handle the payment today, it's about how that payment affects everything else in your financial life, your savings, your investments, your ability to handle unexpected costs, and your overall flexibility with money. And that single decision, the size of the house you choose, can quietly influence your financial situation for decades. When people start searching for a home, they often begin with a very specific question. What is the most expensive house I can qualify for? At first, that question seems logical. Buyers talk to a lender, get pre-approved, and receive a number that tells them the maximum price they can borrow. Naturally, many people then begin searching for homes close to that limit. But there's a problem with that approach. That number is calculated from the lender's perspective, not yours. The goal of the bank is to determine whether you are likely to make the payments without defaulting. Their formulas are designed to measure lending risk, not to ensure that your financial life remains comfortable and flexible. So when buyers focus only on the maximum approval amount, they treat it like a target. A much more useful way to think about the decision is to ask a different question. What level of housing cost allows the rest of my finances to keep moving forward? Because the goal isn't just owning a home. The goal is owning a home while still having room to save, invest, and build long-term financial security. Mortgage lenders rely on specific financial ratios to decide whether someone qualifies for a loan. These calculations are designed to measure risk from the bank's perspective. They look at how much of your income would be used for housing expenses and how much is already committed to other debts. If those numbers fall within their acceptable range, the loan is typically approved. However, these formulas don't always reflect how money actually moves through your daily life. They provide a technical answer about qualification, but they don't necessarily show how comfortable that payment will feel once it becomes part of your real monthly budget. Another issue is the type of income lenders evaluate. Mortgage approvals are usually based on gross income, which is your salary before deductions. In reality, a significant portion of that income never reaches your bank account. Taxes, insurance premiums, retirement contributions, and other deductions reduce the amount you actually have available to spend. Because of this gap, a payment that seems reasonable during the loan application process can feel far more restrictive once you are managing it with your real take-home pay each month. When people evaluate a home purchase, their attention usually centers on the mortgage payment, but the mortgage is only part of the overall cost of owning a home. Homeowners must also pay property taxes and insurance, and larger homes often come with higher utility bills. There are also costs associated with furnishing and maintaining the space. Over time, these additional expenses add layers to the financial commitment, meaning the true cost of homeownership is often much higher than the mortgage payment alone. Maintenance introduces another factor that many buyers underestimate. Unlike the mortgage, maintenance costs do not appear as predictable monthly bills. Instead, they tend to arrive unexpectedly. A roof may require repairs, appliances can fail, plumbing issues can appear, or heating and cooling systems may stop working without warning. Each issue might be manageable on its own, but when housing costs are already stretching the budget, these sudden expenses can quickly create financial strain. And there is an important financial concept known as opportunity cost. Every dollar directed toward housing is a dollar that cannot be used somewhere else.
During the excitement of buying a home, this trade-off is easy to ignore, yet over time it becomes increasingly
significant. Money that goes toward a larger mortgage could have been invested, saved, or used to build other financial assets. To see how this difference plays out, imagine two families with similar incomes starting at the same point financially. One family chooses a more expensive home with higher monthly payments. The other selects a more affordable property and keeps their housing costs lower. Because the second household spends less each month on housing, they have extra cash available to invest consistently. Over the years, those regular investments begin to grow. What started as a small monthly difference gradually turns into a substantial financial advantage as time and compounding do their work. Studies on household finances consistently show a pattern. When a large portion of income is dedicated to housing, financial pressure tends to increase. Families that allocate too much of their earnings toward mortgage payments and housing-related expenses often have less room to respond when life becomes unpredictable. When an emergency expense appears, there's very little flexibility in the budget. Over time, this tight structure makes it harder to build savings or invest consistently, which can slow long-term financial progress. This situation often leads to what many financial experts describe as being house-rich but cash-poor. In this case, a homeowner may possess a valuable property and significant home equity, making their overall net worth look impressive. However, their everyday financial situation can feel very restrictive. When most of a household's income is tied up in mortgage payments, taxes, and upkeep, there may be very little cash available for savings, investments, or unexpected costs. On paper, the household appears financially strong, but in daily life, they may feel constantly limited. Another factor that encourages people to stretch their budgets is the expectation that housing prices will increase dramatically over time. Many buyers believe that purchasing a more expensive property will eventually pay off because the home will appreciate in value. While real estate does tend to increase in price over long periods, the rate of growth is often gradual rather than explosive. A home can provide stability and long-term value, but it does not always outperform other forms of investment. Because of this, relying on housing appreciation alone to build wealth can be an overly optimistic assumption. A more balanced approach to home buying begins with a different type of question. Instead of focusing on the highest price a lender will approve, it can be more helpful to ask what level of housing cost allows the rest of your financial life to remain healthy. The goal is not simply to purchase a house, but to maintain room in your budget for other priorities that support long-term financial stability. When housing costs stay within a comfortable range, maintaining financial flexibility becomes much easier. Households have more capacity to build emergency savings, invest regularly, and manage unexpected expenses without disrupting their financial plans. This breathing room creates a stronger financial foundation and reduces the stress that often comes with tight budgets. Over long periods of time, these structural choices can lead to very different outcomes. Wealth is often built through consistent saving and steady investment rather than through a single large financial decision. When housing costs remain moderate, it becomes far easier to maintain that consistency. Month after month, the ability to save and invest compounds into meaningful long-term growth. Buying a home can be one of the most important financial milestones in a person's life, but the goal should not necessarily be stretching for the most expensive property possible. A more thoughtful approach is choosing a home that fits comfortably within your financial life and allows the rest of your goals to keep moving forward. In the end, long-term wealth rarely comes from maximizing the size of your house. It usually comes from maintaining steady financial progress year after year. Sometimes the most strategic decision is not reaching for the biggest home available, but selecting one that keeps your finances flexible and sustainable. If this discussion helped you see housing decisions from a different perspective, consider subscribing for more clear and practical insights on building lasting financial stability.